Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be examining Elevance Health stock, ticker ELV. As always, this is not individual investing advice. This is just how I analyze stocks. This one came in by request down in the comment section of one of my other videos. If you have a request, just put it down in the comments. I'll get it on the whiteboard behind me. One of those columns I have completely covered, so I'm going to be erasing it soon. So I'm working my way through all these. And if it's a stock that's in the S&P 500, I post those on YouTube for free. The rest I post over on Patreon, even if they're not in the S&P 500. I have a free tier on Patreon where I post all the same videos that you see here on YouTube, plus some extras. And then I also have a $5 tier where you can request, whatever you want, and I'll either reply back to you in chat, or I'll make a whole video for you, whatever you want. And if you join the $5 tier, you can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And those links will be down in the description, along with a 25% off affiliate link for Fast Graphs, which you see me use in almost all of my videos. And they have free trials there too, so you can just try it for free and get, if you haven't ever used it before, you can get that 25% off. Okay, Elevance. So these guys used to be named Anthem. I always forget what their old name used to be. And I made a video for in the first quarter of 2021. I kind of just, as an experiment, started the YouTube channel. I've been writing on Seeking Alpha since 2015. So it's my 9th year doing that. And in the first quarter of 2021, I put out like a series of videos. I had some buy videos, had some sell, some avoids, and then just a couple other kind of investing videos. And then I basically stopped until I relaunched this channel in October of last year, almost a year ago. So I had a big break between there, but one of the buy videos that I had was actually on Anthem, now Elevance. And so here's the tracker that I created for most of the buy or videos on him. I'm used to saying articles. I've written over like 500 articles. And it's up like 60%, outperformed the S&P 500 a little bit. Now it's actually well off its highs. So, and then these are some of the other ones. I'm going to be reviewing these here in a upcoming video, so I'm not going to spend too much time there. Now I actually bought Elevance in the Cyclical Investors Club service a little before that, in December of 2020. I think it might have been a little bit cheaper, and it's up almost 80% with dividends since then. So it's done pretty well. And this is a pretty straightforward stock to look at. I think to examine, as you can see, the earnings are very stable. Pretty much they've only gone up. Now they probably have bought back some shares to kind of level some of this out over time. But they've had a really nice run. It looks like maybe in 2008 earnings were down slightly, but over the past like 20 years. So you couldn't really ask for more than that, other than to maybe get a chance to buy it when it's kind of cheap. So the best time to buy this was was during the Great Recession, and when the U.S. was revamping the healthcare system with Obamacare. A lot of fear was there that health insurance companies like these guys would just be like completely eliminated. So the market kind of freaked out. Like you could have got this at like a 5 PE, and it would have been more than a 10 bagger since then. But I was too dumb at the time to realize how much the insurance companies would benefit from Obamacare. I was kind of against Obamacare at the time. I didn't think it was a good idea, and I let that cloud my judgment. I did not do investing for a living back then. I was just buying things for myself. But so yeah, don't let your political views ever influence your investing thoughts, because I really think if I would have thought that through when people are forced to buy health insurance, it's probably pretty good for the health insurance companies. So I lost out on a pretty big opportunity cost back then, but I was able to buy it again. And so let's do a valuation analysis on it really quickly. Again, it's pretty straightforward. Earnings grow. I have them growing about 14% on average. That might be a little bit high going forward. But who knows? Maybe they'll outperform too. You don't really know. It looks like analysts are looking for 12% on average, but a lot of times companies will beat earnings by a little bit. So when you look at, so the Fast Graphs is at 14.9. I'm just a little bit less than that. So we know what the earnings growth is, and then we can look at the PE ratio, or the well, you can look at the PE ratio, which is a little under 15. Using this fast graphs uses blended earnings. I'll show you what I'm going to use here in a minute. Yeah, let's just look at the numbers. Let's see, find the right spreadsheet. And if it loads, sometimes it wants to load, sometimes it doesn't. Okay, so I have a 14.11% earnings growth rate assumption. Come on, there we go. All right. So, and that works out to, so now the actual stock price is $527, sorry. Once I include their debt, I adjust the stock price up. It looks like I adjusted it up about 25%. So I'm treating this as though the stock price is, because if you buy the stock, if you were to buy the business and the debt, then it would cost $659 a share. And the way I do that on the fast graph is, just for a quick kind of estimate, is I take the market cap. I look at the difference between the market cap and the total enterprise value. So this total, let me see if I can, sometimes it pulls up the definition of it, but yeah, there we go. The market cap plus preferred stock plus total debt minus cash, basically, and other minority interests. So the last time I looked at that, it was about 25% difference between the market cap and the total enterprise value. So that's how I adjust the stock price for the purpose of valuation. And so when I raise the stock price that much, then the PE isn't quite as attractive, but we get an earnings yield, which is the inverse of the PE ratio. So you just put the earnings over the price, and that gives you 5.65% earnings yield. And let's see. So the way I like to think about that is, if I bought the business and the debt and everything for $100, then, and I own the business, it would earn $5.65 for every $100 that you have invested. And that would grow at 14.11% a year. I pull the first year forward, so I get $6.45 a year. What I want to know is, for every $100, how much money could I collect from this business over 10 years? And I basically accumulate that money. Now, keep in mind, the $5.65 is growing at 14%, not the $105.65, just the $5. So that grows over time, and I want to know how much I could collect, and that's what my spreadsheet's set up for. So at the end of 10 years, if everything goes at that rate, my $100 will turn into $225.36. And when you run a CAGR calculation on that, you can just go to like moneychimp.com. There's a CAGR calculator there if you don't have a spreadsheet set up to do it. And that comes out to an 8.46% earnings CAGR. Above 8% is usually like where I would look to buy a stock, and so it looks like a pretty good buy based on just a straight up valuation if there's no like recession like we had in like 2008. So I think there's kind of a couple different approaches for this, and I'd probably just split the difference, honestly, if I was looking to decide whether to buy the stock or not. So using those assumptions, and again, that earnings growth could be a little, maybe they only grow earnings, 8% or 9% or 10% or something like that. Who knows? These companies, so that would be like a 7% CAGR if they were able to grow 10% instead of 14. That's still not too bad. That's still a lot better than the market. But there probably is like some limit to how fast these like health insurance companies can grow. They already take a lot of GDP from the economy. So I don't know if they'll be able to do a 14% rate for 10 more years, but who knows? And if there's inflation, these guys can do a pretty good job of passing that on, I think. So this could be on the optimistic side, I would say. But if you use those assumptions, then $570 a share is a good buy price. It's at $527 right now, so it's below that. So it looks like a pretty decent buy just on a straight up valuation basis based on recent performance, like since like 2016 or so. Now, if there's a recession, then we have to say, how would the market treat this during a recession? Unfortunately, I didn't leave myself a note here what recession I used as a guide. I'm pretty sure I used 2020 as a guide and not 2008, because I do that for most of these health insurance companies. Because actually, I can go look. Let me go. I can tell, because if you just look at how low, like I said, it had like a 5 PE. I can look and see what PE assumption, recession PE assumption I'm using here, which is an 8.8. Yeah, so that would be more from 2020, and then I raise that by 40% because you're not trying to pick the absolute bottom. So this would be kind of like if there's a mild recession or slowdown, or maybe even something just happened. Maybe there's just a recession in kind of health insurance, or they aren't able to grow and the market gets kind of, down on them. That's kind of what this recession buy price would come out to. And that's at like $367, about 30% lower than where it trades now. So it's not a bad, like if we had a bad recession, it probably goes significantly lower than that, I would say. But I think these two spots, if I didn't already own it, a person could definitely buy half now, and I think that's a pretty good deal relative to like like half a position. And then if you get that 30% drop down to like 367, then you could add the rest of your position, and that would give you like a pretty good valuation. And the nice thing about a stock like this is, at least for me, I honestly, other than when I'm writing an article or making a video on it, I don't even look at it. It just like, it just kind of grows, and it's like the perfect stock. You buy it. If you can buy it a little bit cheap, which I was able to do, you get a little bit of a bump. And then even if it just kind of grows at that 14% rate, if you're buying it at a 12 PE, there's not really any multiple compression that takes place over time. So whatever earnings growth they get is usually pretty much translated right into the stock price. And unless, again, the market has some reason to kind of freak out on the industry as a whole and send the valuations down to like single digits, then it's usually a pretty good deal. So yeah, this is definitely one I think a person could start building a position in. I wouldn't take a full like all out position, but I think once you get down to that like 367, 365 area, taking a full position at that point would be totally fine. And it's kind of like a set it and forget it. Now, I take relatively small positions, so I have these guys. I have Cigna too. I might even have another one. So I usually spread those positions around a little bit when the opportunities come, rather than just going all in on something. But I think in terms of having this as part of your portfolio, just buying it when it's at one of these kind of a discount every now and then is a good way. Well, let's just look. I mean, if you added when it was like, that's a little bit before I bought. This is like July 2020 at a 12.73 PE. You're getting like almost a 19% CAGR so far since then. Whereas if you paid on one of these more high valuations back in 2015, like 9 years ago, at a 18 PE, you're getting like a 14% CAGR. Now, up until like 2018, I mean, they didn't grow. They go through periods where they just have some slower growth sometimes. So if we go back to there, they only had 9% earnings growth, right? It's totally possible they could do like only a 9% earnings growth. Again, but you're still going to get okay returns as long as you can buy it at a little bit of a cheaper price. So yeah, I think this is kind of just one of those set it and forget it kind of core. I hate to say core portfolio, but it's not any bigger than any of my other like initial positions, but it's one that you buy and it just stays there and you don't have to do anything. And those are great. I love those. I like them if I can get them a little cheaper, but when you have steady earnings like this, it's pretty rare. Only every now and then do you get an opportunity to buy cheaper, and I think it's okay to just pay like a fair price for this one. At least like half a position for most people, rather than wait, because you never know when the next discount's going to come. Okay, hopefully you found that useful. If you did, hit the like button, hit the subscribe button. Drop a comment if you have any questions or if you have a request. And don't forget to check out Patreon and maybe check out the free tier there. I'm going to be adding some more stuff to Patreon soon, a new tier level even, which is probably coming next week. So keep an eye out for that, and I'll see everybody later.